It is 7 minutes past 10 in the morning on Friday, the 5th of June, the end of another long and interesting week. In today's market broadcast, I've got Kit Winder and I've also got Nikolai Hubble on. And the point of today's broadcast, I think what we're going to do is discuss some of the stories that we've seen this week that we think are worthy of investors' attention. They're things that caught our eye, which we think are indicative of what's to come. Now, Nikolai, let's start with you. What have you seen this week? What stories have piqued your interest that you think offers a glimmer of insight to investors?
I think a lot of what's behind the rally is the fact that the science on COVID-19 is becoming more certain. So back when there was a bit of a plunge in the stock market, a lot of the reasoning for that was that there's this huge pandemic and we just don't know enough about it, the sort of uncertainty. The estimates for how bad it was going to be, how dangerous it was, varied enormously. And that uncertainty was what's behind the initial crash in the market. Now that the uncertainty is falling, the market's rising back up again, especially because that uncertainty seems to be it's indicating, so far at least, that the virus is nowhere near as severe as what justified the lockdown. And if that is correct, continues to prove correct, then theoretically the lockdown should be lifted very quickly.
Yeah, it's an interesting way of looking at it, with the I guess the change in scientific perspective being something that's driving it. Kit, can you tell us something that you've been looking at this week that you think's worthy of our attention?
Yeah, sure thing. But first, I would like to say it's quite interesting because I've gone in the complete opposite direction to Nikolai. I've always liked the idea of the experience curve, where the moment people start finding out about something, they think it's all rather simple. And this was like me with coronavirus. You sort of learn a bit about it and lockdown's coming and you think we've got a lockdown, this is how it's going to work and this is how dangerous it is. But a couple of months down the line, the more I find out about the virus and the lockdown, the more complicated it has seemed to me and the more confused I've become. So I seem to have been going the opposite direction by the sound of it to most people. So I look forward to hearing Nikolai clearing up the science for me actually later on this podcast maybe.
Right.
But one of the thing that I've been looking at a lot this week, it started out looking at value investing. So we know that value investing has had a pretty long decline relative to growth investing. Everyone's been more excited by technology, by huge future revenues, companies like Tesla or Netflix, which are going to be the best companies in the world in 10 years, and haven't really been focusing on, the ones that are churning out 1 million cars per year, for example. So I've been looking at the auto sector, where, Tesla is projected to sort of earn X amount in 2021, and it's valued at 100 times its 2021 earnings. And those aren't even guaranteed yet. Whereas a company like Peugeot, I think is valued on 3 times its earnings for this year, or for last year, which we can be much more certain about because obviously they've already come out. And so all these stimulus packages coming out of Europe. So everyone, European stocks have been doing the worst. Car makers have been doing particularly terribly. And, some major institutions have even declared that maybe 2019 or 2018 saw the peak in petrol car sales. But just coming out of coronavirus, it's changed the picture in quite an interesting way because, you'll have seen news stories about bicycles selling out in London or in different cities across the world as people try and avoid public transport. And I think it's not a massive leap, and I think everyone's got there already, to say that people will be getting back in their cars as well, or trying to find new ones. And so I'm wondering whether there is a new stimulus for value investing because it's underperformed for so long. And within that, whether, the stimulus packages coming out of France and Germany in particular might have quite a lot to do in helping the auto sector drive that turn in fortunes for the value investing crew.
I did see that new UK car registrations have had a very, very bad time in recent months. It will be interesting to see whether or not those do manage to pick up when we get some form of lockdown easing. And you'd imagine that if you're feeling hard on your down on your luck, should I say, that you probably wouldn't be going to buy a new car all that quickly, or certainly not a new one. Maybe go for a second-hand one. But I guess we'll just have to wait and see. Now, Nikolai, would you like to give a riposte to Luke here? To Kit here, over the when it comes to the science, and whether or not this is really been concluded, and whether or not the science really is certain when it comes to the Wu flu lockdown.
Yeah, I think what's changed is the type of science that we're basing our assumptions on. So going into the lockdown, that was based on projections and estimates that were extrapolations. And over the last 2 or 3 weeks, the science that is interpolating, that is judging actual data, has started to come through. And that is obviously a vastly different degree of certainty because it's dealing with real things. Now, it's flawed in many different ways still, and that has become extremely confusing. It's bizarre that different scientists can come up with completely different results in terms of real hard data, but it's still completely different in the eyes of investors. That, on the one hand, we've got a mathematical model from someone who was discredited because of their mathematical models in the past, and the science being based on that, with Sweden and the UK both using those models but coming up with completely opposite policies. Whereas now you've got the actual analysis of people who did die, not people who may die or could die or would die under different scenarios. And because of that change, and because that data is not living up to the projections or anywhere even close to those projections, that is the change in certainty that I think is behind a lot of the market's rally. If you look at what people were projecting and expecting relative to what we do know, the order of magnitude in difference is enormous. And even if we are still extremely confused, especially about how we could get it so wrong, then if you're looking forward, it's looking to be a lot less bad than you would have expected.
Kit, does that satisfy you?
Not really. Firstly, I think my two big questions are, the counterfactual is the key here. What would it have been? So the projections were made, perhaps not based on what ended up happening, which was quite a meek adoption of the lockdown policy. So in the UK, we seemed for the most part to take it pretty well. Everyone stayed indoors. Everyone was pretty careful about social distancing. People were soiling their pants if they saw someone within 10 meters of them on the street. They'd cross to the other side. So I wonder how bad it would have been if no lockdown measures were ensured, and the science that Nick is talking about. And he's right to question it. I'm not sort of challenging it in any way, but I do just wonder how much of the current data that we're seeing of how bad it has been is based on a complete abnormality, which is a society entirely in lockdown. I think the more interesting thing is sort of the categorization of how the virus has spread, not by country, but more specifically by sort of age groups or by more local bits of geography, so city to city or county to county in the UK. I mean, America's got this amazing map of sort of 90% of its cases are in just 7 cities or something like that. And so, yeah, I don't know. That's my sort of what would have happened if we hadn't have locked down is the thing I wonder, because of how multiplicative the disease is, how quickly it spreads when we are behaving normally.
Right. I think that's a fair enough riposte. Nikolai, have you anything more to add to that before we go to our next story to discuss?
Yeah, the infection fatality rates that suggest that coronavirus is not significantly worse than a severe flu don't depend on the levels of lockdown. In fact, the lockdown has been discredited as being a significant indicator of whether your coronavirus is spreading is particularly bad or not. There's all sorts of other indicators that have popped up that are important. But the severity of the disease and the lockdown connection doesn't have to be direct in the types of analysis done. A lot of those analyses are of places that were before lockdown occurred. So they're meta studies of lots of different countries analyzing lots of different figures. And they all came to surprisingly similar conclusions. So I think the newer data is a lot more robust than what we were basing our assumptions on that justified the lockdowns in the first place.
Right. Now, I think for our next, I'll raise something I've seen over the last week, which I thought was pretty interesting, or it seemed somewhat amusing, at least for me. I don't know if you fellas saw it, but yesterday Elon Musk went after Jeff Bezos on Twitter, saying that because Amazon was censoring books, which were preventing which were proposing that what was being done about the Wu flu was an incorrect response. And I don't actually know in terms of the actual context of the book what was said in it. Or what claims was being making. It was just something I saw sort of as an aside. But it was because somebody was trying to sell a book through Amazon. Amazon, of course, is now a huge publisher, effectively. It'll print the books for you and everything. And they were trying to do it on the Wu flu lockdown. And it was getting censored. It was getting pulled. Now, Elon Musk now responds to this. Elon Musk has obviously been very vocal about ending lockdowns and saying, but he amped it up to the next level, saying that Amazon should be broken up. We need to end monopolies. And he's going out there on Twitter and saying this is, almost sort of taking the Trump initiative there. What do you fellas make of that? Do you think this is, do you think that this is him trying to sort of distract from what's going on at Tesla? Do you think he genuinely believes that, we can try and get some antitrust action going on by starting on Twitter? What do you think's going on there?
Who knows with that man, Boaz? Who knows? I think it is a pretty clear reflection, though, of his run for presidency, because that's becoming an increasingly popular trait, and he's using Twitter as his predecessor has to gain followers. And so that's why he's anti-lockdown, and that's why he's anti-big monopolies. I think it is part of a run for president, probably.
That's a pretty big call, Kit, I must say. I can imagine. Who would be his running mate, though?
Trevor Milton.
Nikolai, what do you make of it?
I just don't understand what he's saying, because the idea that Amazon's a book publishing monopoly is just stupid. I don't know what else to call it.
Well, he didn't say specifically that it was a book publishing monopoly. He simply said Amazon is a monopoly and needs to be broken up in response to Amazon, preventing the publication of one book. So, he may have been meaning it more generally, perhaps.
I'm sorry, but there's no business more competitive than online publishing and online retail. Like, that's just ridiculous. That a monopoly is a legal grant from the government. You're the only one allowed to do something. This is the opposite. Amazon's performed the way it has because it's an excellent service. It's totally bizarre to call it a monopoly, and it's just misguided.
That's not the only reason it's performed so well, though. It has other abilities which are akin to the benefits of a monopoly, in the way that it can, because it has all of the data from all of its suppliers and it has all of the capacity to produce things itself, it can study the data of its competitors, make the same product itself, and then undercut its competitors. So it has sort of, and because Amazon is the most popular, it has a monopoly on, popular choice almost. You're right, because it's done so well. But it can, completely do other businesses over just by stealing their marketing and sales data because they've been on Amazon's platform, then creating the same product and undercutting it. And they have nowhere else to go, because if you're not on Amazon, you're going to struggle.
It sounds to me like they're just doing consumers worldwide an extraordinary favor by providing better services, better products.
That's not entirely true, though. So, for example, if during this pandemic, if you looked for a picnic chair on Amazon, it would cost you 40 quid. But if you went on Argos, it's 8, because Amazon are doing demand pricing, where when demand goes up, they put prices up. It's like surge pricing on Uber, whereas a lot of other companies aren't doing that. But you don't think to go on Argos before you go on Amazon. I've got Amazon bookmarked, but not Argos. So they're not entirely doing the consumer a favor.
But everything you've just described is the opposite of a monopoly. It's a competitive system. And your bookmarking is showing that you favor Amazon. That's, again, the opposite of a monopoly.
Yeah, that's true. But I'm just saying.
Well, I think there's the whole definition of monopoly. I think is something that is we're somewhat at cross purposes here, because Nikolai, you're saying that monopoly is something that can only be granted by the government, and that's not. That's while that is I think a valid definition of what a monopoly is, I don't think that's the definition a lot of people use. So I think a lot of people, I say a lot of people, you often see allegations against big tech for simply buying up all of the startups and all of the competition, because they've managed to attain this vast scale, and of course they have this terrific access to capital, which they can buy, borrow vast quantities in the credit markets at relatively short notice, and they're very good at just buying up companies that may possibly rival them at some point in the future. And Amazon certainly has And Amazon certainly has done that to some degree. Facebook's done it a lot. It probably gets most of the stick for it. Google has an entire sort of division that does this kind of thing, where they're just sort of scouting to find new companies and new businesses. But it's that definition of what a monopoly is. And Amazon does do a lot of work for the government. I mean, they were going to get that absolutely gigantic Pentagon contract. And there was the whole allegation as to whether it was Donald Trump who'd personally found a way of vetoing Amazon from getting it, and so Microsoft got it instead. There is plenty of government sort of assistance there. I mean, there are a bit, when it comes to lobbying as well. Big tech is. I could be wrong on this. Don't quote me on it, but I do remember seeing that in terms of the amount of money spent on lobbying in Washington. The big tech firms were outspending Wall Street, which is generally something which is pretty great feat to make.
Yeah, that's the problem. That's where the issue is. When the government has power to influence things and to grant large contracts, then the whole capitalist competitive process instantly breaks down entirely. So even a small influence of that sort has a huge impact. But the online retail world is just so extraordinarily competitive. And the particular issue that brought on this topic, the book publishing, it's just bizarre. Of all the things to point out about what Amazon did in censoring that book, arguing that it's a monopoly is the last one on the list. It's horrific what they did and wrong, but they have the legal right to control what they publish.
Yeah, I mean, well, this lends itself more to my question, I would say. So if Elon Musk is obviously not stupid, right? So what is he trying to accomplish by making this public allegation on Twitter? So there is plenty of anti-big tech political rhetoric right now. Do you think he's trying to maybe achieve something when it comes to garnering support from his following and from others?
Yeah, I suppose everyone hates the guy who censors the book, regardless of what's in it. So that's the more popular position to take.
Moving on slightly. Kit, can you give us another story that you've been looking at this week?
Well, the other big one from a sort of environmental perspective is, have you seen this big fuel spill in the Arctic?
Yep.
That's obviously, I think they think it's going to be the biggest fuel spill since Exxon's Valdez spill. It's going to be 21,000 tons of oil. But I think one of the interesting things is it's going to turn the global media focus onto what's going on in the Arctic in the first place. And it turns out, the Boaz, you and I spoke about this back in the office days of 2019.
So
that America, China, and Russia are actually taking the Arctic Circle very seriously from a strategic perspective because of the minerals it's got, oil and gas, obviously, but also some rare earth minerals. Trade routes is obviously the big one as well for Russia, because as the Arctic melts, they see that as a huge opportunity. So they're loving climate change because it means they can transport oil and gas, which is very plentiful in its northern Siberian regions, instead of transporting it all the way around over the top of Europe. They can go along what they call the Northern Sea route, which is east from the northern tips of Russia around Kamchatka and down to Asia that way. And obviously Asia is such a big market for their oil that cuts the cost and the time of shipping oil and gas to China in half. So they're loving climate change.
Well, it's not just Russia, It's pretty much all of the major powers have been thinking about this, and all the major developed militaries have been commissioning the construction of many icebreakers, a vast icebreaker fleet, because they all want to get in on this action with paving a new trade route all the way through the Arctic. There's that council, like Global Council. I believe it's for near Arctic countries. China has, in its great soft power way, has managed to qualify as a near Arctic country, so that they can be part of the power broking and the squabbling over the Arctic. It'll be very interesting to see the kind of things that Russia have been up to with building, military bases, expanding their military bases around there, and then of course the US has plenty of military installations in Alaska and the like. It'll be very interesting to see how it turns out. I mean, what do you think this oil spill is going to do for that dynamic, between Russia and the other near Arctic powers?
Well, you just wonder, sort of oil spills do drag focus of the entire climate movement. And if they start turning on Russia for their performance in oil safety in the Arctic, America could pretty cheerfully jump on that bandwagon, try and impose some more sanctions or do anything that they could to try and reclaim some strategic advantage in the Arctic. Because China, as you say, China and Russia have been pushing that boat pretty fast.
Yeah. Nikolai, have you any other stories you'd like to share with us this week?
Yeah, I think the gold market's been interesting in the last week and a half. There's been a huge amount of turmoil in the gold market, but not the gold price. And I found that divergence really odd. So we had this wedge-shaped gold price trading build up where people expected the gold price to either break up or down significantly. And the opposite's happened. It's been trading sideways effectively since breaking out of that wedge shape. So the typical chart analysis has failed. But while that's happened, an extraordinary amount of things have happened in the gold market itself. And it's sort of similar to what happened in the oil markets, where the price went negative because of issues in the futures market. There was issues about taking delivery of oil. And the same sort of thing happened in the gold price without the price reaction as a result, where you had a shortage of gold that was suitable for delivery in New York because of coronavirus issues in in Switzerland, where a lot of the gold production for those gold bars that are suitable for delivery in New York was shut down by coronavirus. And as a result of that, you had a shortage of physical gold in the futures market in the US. Now, this caused a problem in a surprising way. You've got several banks that are active in the UK gold market, which is effectively the spot price of gold. And they're usually long gold in that market. They're usually betting that the gold price will rise, just as an effect of their role as market makers in that gold market. And they usually hedge that position to bring their position on gold to neutral by selling gold futures in New York. But because of this gold shortage in New York, the gold price in New York surged, while not surging in London, where they didn't have the same problem. And this divergence cost the banks that are active in the gold market huge amounts of money. They made big losses, far more than they're technically supposed to make under regulations that cover their risk. And as a result of this, they are speculating a lot less now in the gold futures market in the US. And actually one bank has exited the gold business altogether. And all of this has sort of been churning around in the gold market without the gold price making a big move. And I found that very interesting and very odd.
Yeah, I remember looking at that story when things were getting pretty wild, and I remember at the sort of peak of that, as you described, there's that mismatch between gold that was required in New York and us not having the problem with it in London. And if memory serves, what ended up happening was 400 troy ounce London good delivery bars were shipped out to New York on the COMEX, even though they're only meant to accept 100 troy ounce good delivery bars of a higher purity. And this was, considered very, very outside of the norm. But when you consider, I agree. When you consider so much of the gold price, when people think of the gold price, is driven by price discovery in the COMEX and London markets, it does seem very strange that the gold price didn't do anything. And of course, that definitely lends itself to all manner of speculation as to what may really be going on behind the scenes. So do you care to comment on that?
Yeah, just firstly, it wasn't just from London that the gold was shipped. The Perth Mint in Australia actually started manufacturing gold suitable for delivery in the US under COMEX rules. And it was actually considered profitable to send that gold to the US from Australia because all of the commercial flights had been grounded because of coronavirus. So there was all these empty planes sitting there, and the Perth Mint decided to fly its gold to New York, which is just bizarre.
Yeah.
But yeah, I think what is likely to happen now is that a lot of what had been suppressing the gold price in the futures market in the US is likely to not show up in the market anymore. So these banks got smacked in the face by what happened when the gold dried up in New York, that they're no longer going to use the US market as a gold hedge in the way that they had been. And that's going to reduce a lot of the selling pressure that conspiracy theorists and reasonable analysts alike argue has suppressed the gold price over time. And if I'm right about that, then this is a great time to be buying gold, because the price should be relieved of that selling pressure.
One thing I've noticed in the gold market this week was the new release from Gold Hub on the topic of ETF holdings of gold. Another form of paper gold, as gold bugs would describe it. And this is, of course, the way through which many investors have exposure to gold. They buy shares in the gold ETFs, and in the gold ETFs this week, we have already, in fact, just over the first 5 months of this year, gold ETF holdings have increased by a larger amount than they have ever before, and so we've surpassed the 2009 record for, I believe it's 591 tons of gold that were added to gold ETFs in that year. We're already at 623 tons that have been added to gold ETFs so far this year, and we're only halfway through, which I think speaks volumes as to the amount of the amount of investor demand that there is for gold. It's almost like it's got a much more visibility these days than it did even during the global financial crisis. And I think that it says something that I think there's maybe some side to that I'm not quite seeing yet, as to just really where all of this investor demand is coming from. Because across when you look at all the financial media, you don't see that much crazy speculation when it comes to gold, or at least I don't. Maybe I'm not reading and looking in the right places. But when you're reading the pages of FT, sure, they've got plenty of articles on gold, and every now and then they'll do another one with how the coronavirus, the lockdown has affected some of the mines, or maybe some of the refiners. But when it comes to really vast investor demand, when there's huge speculative activity and you've got loads of people, loads of retail investors really jumping on the bandwagon, that's not something I've witnessed just yet. Now, Kit, when I sent this around to some of our colleagues earlier this week, you came back to me with a question on this, and as I recall, you were asking whether or not this is a symptom of speculative excess, right?
Yeah, well, I was wondering, when you see a record, quite a serious one as well, 5 months of inflows being larger than the greatest ever annual inflow. Yep. You wonder, as you say, we've not been seeing huge signs of excess in the way that you just described, and yet here we have a very definite sign of that excess. So it's very hard to decide whether what we're seeing now is the beginning of a massive trend or the end of quite a small one.
Right. I mean, excess implies that we already know that it's too much, right? So, I mean, I think I would sort of rail against the idea that we know that this is excessive, because we don't. I mean, maybe it's actually far too little. Maybe investors are actually going to buy way more than that in the years to come. Considering some of the policy actions that are being proposed, maybe that'll be the case. So I think I would urge caution when it comes to claiming that this is excessive. But it definitely is a very big milestone, and it's not something we've heard too much about. I mean, that's a major record to have, and that was only 5 months. That's not even we're already almost a week into June, and we've already had plenty of action in the gold market, as Nikolai has been describing. So
part of the background story to the ETF holdings is that futures activity is down massively. I think it was 30% for one of the particular months. So the potential explanation for the ETF holdings is that a lot of the institutions which used to get exposure to the gold price in the futures market have transferred to the ETF market because of the turmoil that I was explaining. So if you did have speculative excess, you'd expect the futures market to be spiking as well. I think the bigger concern for whether the gold price is at the end of its run is the fact that it's outperformed stocks so dramatically over the last 20 years. It's been an extraordinary run, and during the COVID crisis as well. And that sort of run should end at some point. The gold price can't just outperform forever, or at least it would be a bit bizarre if it did. So that is my biggest worry for whether Kit's right in his suggestion that this could be the end of a run.
Yeah, I think that that switch from institutions, no longer trusting futures as a valid means of getting exposure to the gold price. I find that quite compelling, and and it would make sense just switching from that futures form of paper gold to another form of paper gold that is very very cheap to own. It will be. I think that's probably one of the most compelling, sort of reasons for why we have seen just such a surge in that last few months. Because of course with the futures, I mean, it's always the futures. You don't have the gold until delivery. No one ever really takes delivery. But with an ETF, you at least do know that you have a immediate claim on gold rather than having to wait to the end of the month. Now, of course, then you get into all of the theories as to whether or not the ETFs have all the gold that they claim they do, et cetera, et cetera, et cetera. But I mean, it's that immediate claim is, it's a lot better than a claim for a month's time, right?
Yeah. One of the other things, Boaz, is perhaps it reflects more about investor interest in ETFs than in gold. Because that's valid. 2009, right?
Yeah, indeed. Yeah, I mean, the ETF market has completely exploded since then. And there are ETFs of ETFs now, and there are new ones being launched actually all the time. Funnily enough, the Royal Mint launched their own, not an ETF per se, but it's not an exchange traded fund. It's an exchange traded commodity, I believe. It's an ETC, which is just another form of exchange traded product. But they launched that, as I recall, at the end of last year. So that's another gold ETF that has been managed by the Royal Mint. I believe the ticker is RMAU. And that was just had last year. That's just another launch of another ETF. So yeah, I mean, maybe this is actually reflective of just the gold boom and people just wanting ETFs. But that is all we have time for today. So I think we shall wrap up there. Nikolai and Kit, thank you very much for joining me. It was very fun to do these. We'll hopefully do some more of these, in fact, in the near future. We shall be back again next week. Hope if you're listening to this that you're going to have a very good weekend ahead of you. And we shall see you again on Monday.